Have you ever closed your laptop at the end of a session, stared blankly at your depleted account, and felt that sickening knot in your stomach? Wondering how another guaranteed setup just blew up in your face? How long can you keep telling your family you're just one breakthrough away, while years of hard-earned savings quietly bleed red? The truth isn't just that you're losing, it's that institutions actively rely on you. Breaking 5 execution rules so they can fill their own massive orders using your equity. Most traders treat execution like a casino. And if you don't fix these structural flaws today, your trading journey will end in a painful, costly exit. What's up, traders? Welcome back to Synthetic Alpha AI. Let's get into it.
Have you ever closed your laptop at the end of a session, stared blankly at your depleted account, and felt that sickening knot in your stomach, wondering how another guaranteed setup just blew up in your face? How long can you keep telling your family you're just one breakthrough away, while years of hard-earned savings quietly bleed red? The truth isn't just that you're losing, it's that institutions actively rely on you breaking 5 execution rules so they can fill their own massive orders using your equity. Most traders treat execution like a casino, and if you don't fix these structural flaws today, your trading journey will end in a painful, costly exit.
That brings us to rule number 1. You must lock in your invalidation point before you touch the buy or sell button. The deadly mistake struggling traders make is entry-first sizing, opening a trade based on how much they want to win, slapping on an arbitrary lot size, and panic searching for a stop loss while floating in red. If you've ever widened your stop loss mid-trade, you've signed your account's death warrant. You are trading on pure hope, and hope is the most expensive emotion on Wall Street. To fix this instantly, reverse the process. Dictate your dollar risk first, never exceeding 1% of your equity, and let the market's logical structure dictate your position size. Once that order is placed, your risk is capped, your mind is silent, and you force the market to play on your terms, not the bank's. That leads us straight into rule number 2. You must enforce a hard daily circuit breaker, or the algorithms will force one on you. The dirtiest secret of institutional desks is that they know retail traders rarely blow accounts on a single bad trade. They blow them in the 60 minutes after a bad trade. The second you take a loss, your brain floods with cortisol, triggering an evolutionary impulse to fight back. That's when you double your lot size, abandon your edge, and revenge trade directly into an institutional liquidity dump. If you've ever wiped out 2 weeks of solid gains in a single chaotic afternoon, you weren't trading the market. The market was trading your emotions. The fix is an unbreakable mechanical law. Set a daily circuit breaker of 2 consecutive losses or a hard 2% equity drawdown. The millisecond you hit it, your platform closes and your day is dead. Walking away isn't quitting, it's cutting off the algorithmic bleeding before your hard-earned savings evaporate into thin air.
Which brings us to rule number 3. Stop trading out of boredom and hunt strictly for institutional liquidity sessions. Most retail traders treat Forex like an all-day arcade, clicking buttons during dead market hours when volume is flat and price is just generating noise. What most don't realize is that institutions use these low-volatility dead zones specifically to build liquidity pools, engineering fake breakouts to trap eager retail orders on zero volume. If you're opening positions at 2 p.m. out of pure boredom, you are feeding your account straight into the house. To trade like an institution, you must align strictly with peak volume overlaps, specifically the London and New York session opens, where real institutional order flow drives true displacement. If the big money isn't in the market, your trade isn't a setup. It's just a coin flip designed to bleed you dry.
Which brings us directly to rule number 4. Stop taking equal risk trades and demand asymmetrical risk to reward on every single execution. The reason 90% of retail traders stay trapped on a soul-crushing treadmill of breaking even or bleeding out is simple. They risk $1 just to make $1. With a 1-to-1 ratio, a single losing trade wipes out your entire previous win,
forcing you to maintain an exhausting 60 or 70% win rate just to survive. Institutions don't play that game. Smart money operates on asymmetry, entering at key structural levels where their downside is tightly capped and their upside expansion is wide open. By enforcing a minimum 1 to 3 risk-to-reward ratio, you completely rewrite the math of your account. Suddenly, you can be wrong on 60% of your trades and still walk away wildly profitable at the end of the month. Stop trying to predict where every candle goes and start positioning yourself so one solid win erases your last 3 controlled losses.
Finally, we hit rule number 5. Treat your trading history like an institutional firm auditing a rogue trader, or prepare to repeat the exact same costly mistakes forever. Most retail traders log off after a bad day, close their charts in frustration, and pretend the session never happened because facing their losses hurts their ego. But ignoring bad trades is precisely why you keep making the exact same emotional errors month after month, burning through cash meant for your family's future. Institutions don't run on ego. They run on cold, unyielding data. You must keep an uncompromising performance journal that logs not just your entry, exit, and risk to reward, but your exact emotional state when you clicked buy or sell. When you audit your execution weekly, patterns emerge instantly. You'll spot the exact time of day you bleed money, the low-quality setups you repeatedly force, and the emotional triggers behind your revenge trading. The moment you start measuring your execution with brutal honesty, trading stops being a gambling addiction and transforms into a repeatable, scalable business.
When you stack these 5 rules together, something profound shifts. You stop fighting the market, and you start operating like the institutional firms that have been taking your money for years. Financial freedom in trading doesn't come from finding a secret indicator that never loses. It comes from building an ironclad execution model that protects your capital when you're wrong and scales your account when you're right. Make today the line in the sand, where you stop trading like an undisciplined retail gambler and start executing like an institutional business. But fixing your execution is only half the battle. You still need to know where smart money is lying in wait. Click the video on your screen right now to master high-probability market setups step by step, and I'll see you over there.
That's it for today. If this helped, smash subscribe, and I'll see you in the next one.